Hello there, ladies and gentlemen. Got a good one for you today. We're talking about none other than Target stock. Obviously, they reported earnings in the pre-market today, obviously. But here's the deal. Your boy's been at work today, okay? We just got home. We're going to look at these Target earnings, obviously, because the stock's had a lot of movement, and we're going to see what the heck's going on here. Down 6.79% today. But the initial reaction was quite positive. The stock was up over 2.5% off the initial reaction. But then things took a little bit of a tumble. So, if you remember from what I have previously said in my earnings to watch video, I expected some good numbers out of this company. Really good e-commerce, expecting it close to 150% ideally. We'll see what it looks like, but expect really good comp sales, best quarter in the history of the company. We'll see what we got. Over 15% comp in my opinion, but we'll see. So, that makes me happy. What? It's what we call a smasher, baby. Non-GAAP EPS of 267 beats by 13 cents, and a GAAP EPS of 273 beats by 29 cents. That's called a massive beat right there on the top line. I love to see that on an EPS line. I love to see it. Now the revenue, even more incredible, even better than I expected. Revenue right here, of 28.34 billion, up 21% year over year, beats by 920 million, nearly $1 billion beat. That's right, from a retail company. That's what I think is quite incredible. You need to take that into perspective. That's probably why the initial reaction was definitely positive on this thing, in my opinion. So, comp sales came in at 20.5, which is significant. Over 20% comp is really impressive. And we saw a traffic growth of 6.5 and an increase in average ticket by 13.1. Typically with these companies we've seen this year, the traffic has actually decreased, but ticket prices have gone up. So it's good to see that they were able to increase both, which is why you see this comp sales number so high. Store comp sales grew 6.9, which is still significant, but the digital is the main story here. Grew 118%. I thought they were going to absolutely smash and hit a 150% line, which would be incredible. Don't get me wrong, it would have been incredible. But 118% growth in digital sales is, that's incredible. It's over doubling your business there in that time period. So, really just beyond what anyone could expect. 2/3 of the company's overall comp growth came from digital sales. So that just shows how much bigger it is right now, and how much bigger in the future this comp sales number is going to be. Same day services like order pickup and shipped grew 212%, led by more than 500% growth in drive up, being you drive up and order gets delivered right to your vehicle right there. Really significant. 500% growth, that's freaking crazy. In the face of uncertainty, the company is not giving guidance. Now, this isn't a shocker at all, because most likely this year they're facing the toughest comps of all time. And I think this could be part of the reason why the stock is down. It's going to be facing the toughest comps in the history of the company, because they're coming off a year in which they grew 20% in comp sales here. It's going to be hard to really compete with that. You're talking about they have to make up for the increased demand we saw due to a pandemic. It's just not feasible. I do think overall they will increase their business compared to 2019. There's no doubt. But comp sales in this year, 2021 here, likely are down year over year. It's probably pretty close to neutral. But overall, there's a good chance they have a negative comp sales year, just because of the fact that it increased by such a significant margin already in 2020. So you got to keep that into consideration when you're looking guidance. Believe it or not, these people at Wall Street, these fat cats running the market, they're not that intelligent. Let's just be clear here. They don't know what they're doing here. They entirely are trading off reactions. Good grief. They don't think about things logically like I just did for you. I laid it out very logically, but they don't think about it. They just don't think. So Obviously, we saw comp sales that. Gross margin came in at 26.8% of sales, matching the consensus. Operating margin at 6.5 versus a 6.4 consensus. Overall, improvement there. Pretty nice. No guidance. What a shocker. What a shocker. Okay. What a shocker. So, with the strength from Brian Cornell here. With the strength of our unique multi-category assortment and flexibility we offer through our reliable and convenient fulfillment options, we gained nearly $9 billion in market share in 2020 and grew our revenue by $15 billion. That's quite significant, I must say, which is more than the 11 prior years combined. That's quite a lot of money. As we look at 2021 and beyond, we see continued opportunity to invest in our business and our team. Building on strong foundation we've established to drive market share gains and deliver profitable growth for years to come. I agree. I agree, Mr. Brian Cornell. Looking at the press release, seeing if we see anything significant, but obviously we saw good stuff. Continue to grow market share. It's important stuff to see. For the full year, they saw sales growth of more than $15 million. So comp sales for the full year grew 19.3. I mean, you can't grow 20% and then just have another year of growth. It's just hard to do. Ugh, that's just crazy stuff. 145% growth in digital sales this year. Crazy. Digital sales grew by nearly $10 billion, driven by 235% growth in same-day services. GAAP EPS came in at $8.64, which is 36% higher than last year. That's pretty darn significant, and gained $9 billion in market share. So, again, as I've talked about this, when you look at this company and you look at the future and really the valuation, that's what I think is pretty absurd, because we have some of these tech stocks which are trading at ridiculous valuations, while a company like Target has even lowered their PE after today. We're talking about a company trading at a 20 PE, which just grew 20% this year. 20% this year, trading in a market cap right at what their sales are for the year. We're talking about this is right at their sales line. Market cap after today probably is under what their actual revenue line looks like. So I think that's pretty absurd with this stock. Obviously, we talk about buying, selling afterwards. So let's get into this balance sheet. Total current assets, year-over-year comparison, they're coming in at $20.7 billion compared to $12.9 billion. Really due to an increase in cash and cash equivalents, no doubt, but also an increase in inventory as well. Total assets in general coming in at 51.2 compared to 42.7. Most of that just due to current asset growth. Liabilities, current liabilities are at $20.1 billion compared to 14.4. Growth there mostly due to accounts payable going up. And total non-current liabilities at $16.6 billion compared to 16.45. So it is good to see that they were able to raise capital, yet not see a massive increase in terms of long-term debts. That's pretty impressive. Overall, shareholder equity here has increased $14.4 billion. That compares to 11.8 of the year prior. So there is growth in this balance sheet too. It's a pretty nice balance sheet for a retailer, no doubt. I'm perfectly happy with this, and this EPS line seems to keep growing. Again, I mentioned this with the valuation of this stock. It's pretty darn cheap. You look over the last year, the stock's definitely up. I mean, it's up 63%, which is quite significant. But overall, in terms of valuation, this thing is still trading pretty darn cheap. It was trading darn cheap before that. The stock's performed really well over the last 5 years. No shocker, really it's performed really well since I bought it. You know what I'm saying? But with a sweet, delicious dividend on this company as well. I mean, I'm a buyer of this company. I'm a buyer of this stock right now at these levels because I think the market's unfair in its reaction here. It's unfair to bring this thing down 7% nearly off something that, frankly, was a freaking good earnings. And I don't think you can deny that this was a good earnings. And unless you're going crazy, but you might be, for all I know. If you're going crazy, you're going crazy. But this is a darn good earnings. I hope you enjoyed this and that you have a swell day. Bye-bye.